The Road to Autonomy is presented by the Road to Autonomy Index. The Road to Autonomy Index is a rules-based equity benchmark index that measures the performance of a basket of global companies that are involved in the development and commercialization of autonomy. Institutional investors and fund managers are watching megatrends that are shaping investment opportunities today. These megatrends are creating thematic investment ideas and opportunities for forward-thinking investors. We believe that one of the biggest megatrends today is autonomy. That's why we created the Road to Autonomy Index, the world's first and only pure-play index to track the thematic investment opportunity in autonomy. Follow the Road to Autonomy Index on your favorite finance app by simply typing in the ticker Autonomy. To learn more about the Road to Autonomy Index, visit roadtoautonomy.com/index. Hello and welcome to the Road to Autonomy. I'm your host, Grayson Brulte. On today's episode, we're absolutely honored to welcome back Dean Foreman, Chief Economist, Texas Oil and Gas Association. Dean, welcome back as always, sir.
Thank you, Grayson. Happy New Year.
Happy New Year to you as well. We're just in the early days of 2024. We're in the first inning of a 9-inning baseball game, or the first month of the year. And Dean, we have you on every quarter. So as we enter the first quarter of 2024, what is the outlook for the oil and natural gas markets?
The outlook for oil and natural gas looks bright as we're entering the year with the world having just set a record, right? New highs, 101 million barrels per day last year of global oil demand, nearly 400 billion cubic feet per day of natural gas in 2023. Record demand, of course, implied that there was record supply as well to meet it, right? And that's helped to keep energy prices at historically low levels with supply stepping up to meet that demand. That in turn has reinforced the economy with those relatively low prices and demand heading into this year. So now the attention's turning somewhat to geopolitics, especially in the Middle East, in addition to the economic concerns that we've continued to have. So I think it's solid, and we're looking now toward the economy and geopolitics in tandem.
Where's the additional supply coming from? I like the term supply stepping up. Where's that supply coming from? Are we drilling more? Where's it coming from?
Well, the United States for oil has continued to be the largest source of supply growth for natural gas as well, and stepping up as liquefied natural gas or LNG exporter, and now the largest in the world, plus a substantial pipeline network going south to Mexico that's helped on the gas side. For oil, the role that OPEC Plus has played in stabilizing the market can't be minimized. That's continued. But when we look at futures markets right now, it's interesting that the normal state of futures markets and prices is that they go down over time. And right now they go up, at least for the next 4 to 6 months. So the term contango. And that says that the financial markets expect that the market will get tighter over time relative to where we stand today. It's also interesting that yesterday we saw the Biden administration announce that they're going to repurchase some oil for the Strategic Petroleum Reserve, also saying that the official view seems to be that this is probably a good time to stock up.
Okay, so let's get into politics, geopolitics. There's a new president of Argentina. Chevron is now back in Venezuela, or I'll use the word announce. I'm not sure if they actually have boots on the ground in Venezuela, but Chevron has announced that they're there. With, let's call it South America coming online, does that start to add more oil into the market?
In the longer term, I think so. I mean, Argentina, because it has shale oil, the Vaca Muerta formation in play, it's like the Marcellus in the United States, except it's much deeper and super high quality rock. They have the potential to really flip and become an exporter, much like the United States has, but they haven't had the business climate to be able to support from a macro perspective companies with predictability, trusting to go in and invest a lot in the ground. But the rocks have been so good that many companies have taken a run at it. And so that's one potential play that could develop in the future, but it will take years. Venezuela is somewhat different because it has been so corrupt. They've expropriated or nationalized assets in the past. We're going back 20 years now, but that has long legs. It's really hard, even if Chevron can expand incrementally. If they want to greatly expand production, they're going to have to invest a lot of capital, a lot of people on the ground doing that. Now, in this period with the Maduro regime, since Hugo Chavez's regime, they've made a lot of promises and taken on a lot of debts, both to China and Russia. So the clearest path to increasing production and the contribution from Venezuela would seem to me to be Russian or Chinese presence because they have leverage in multiple ways. Those would be the countries that could play, that could offer technological assistance and could expand. So I wouldn't look to the Western international oil companies to be the ones that are rushing back in to expand the production capabilities in Venezuela. But if the sanctions are lifted, as the potential with political progress is there for that to happen, then in time you could see more production. But it's not going to be game-changing for this year or even next year.
Well, let's say hypothetically staying down in South America, let's go back to Argentina. Let's say President Milei gets his reforms through. One of them, which we're a big fan of, and we're very shocked and pleasantly shocked to see that he wants to legalize self-driving cars in Argentina. That was part of his manifesto. That was a big part of it in there. So let's just hypothetically say the reforms go through, their inflation, which is running rampant, gets under control. Well, at some point, will Western companies go in there because of what they have with the potential of the shale oil? If there is a stable government, lower inflation, job creation, and an economy that's not 70% reliant on the services industry, with the majority of those services being focused on the tourism industry?
I think that with a more stable macro environment, there's no question that the geology is there. One of the challenges historically in Argentina has been the proximity of where the resources are relative to infrastructure. So, for example, if you could produce a lot of natural gas, but could you get it to a major metropolitan center? And that's required building or expanding pipelines that have also been challenging given the geography. That said, the ability to export, access to sea, those things from the region where Vaca Muerta is, have the potential to continue. This could be a next leg, a next shale provider after the United States. But it's a longer term scenario. It's not in the short term where we're looking the next year or two where you're going to see a step change. Today, if you were going to try to do it, I think you have to say it gets worse before it gets better. I mean, the change of the regime, the currency, trying to curb inflation, all of this is experimental. And who knows politically how, when the rubber hits the road, does it get traction and take off and make a successful change? It's going to take a lot of careful handling to make sure that the economy can make that transition.
It's the long term. You're right on that. It will take a lot of kit gloves. It will take a lot of finesse to do it. If they do pull it off, it becomes very interesting to see what the impact will be on their economy, what the impact will be on their exports. And then coming back to America here, you and I both read the Bloomberg Terminal. Analysts are on one side, analysts are another. They never seem to agree except on certain things. They agreed on Apple for a long time. And now they're diverging on Apple. But one thing that I'll say a majority, not all, but I'll use the word a majority of analysts are predicting the U.S. economy is going to have a soft landing. Me personally, I'm unsure. If we do have a soft landing for the U.S. economy, what will the impact be on the oil and natural gas markets?
A soft landing would be very constructive for oil and natural gas markets, almost no question about that. So energy demand generally follows economic activity, and the consensus view right now is for modest growth this year and next, just below the long-run average growth level of around 2.5% per year. And that could, from the records that we talked about last year, bring global oil demand to consecutive records now for the next 2 years of over 102 million barrels per day this year and 103 million barrels per day in 2025. The story is similar for natural gas. So it's set record highs every year since 2020 with the pandemic, and it's been ranging now from just below 400 billion cubic feet per day last year to being around 400. That should be a milestone, 400 billion cubic feet per day this year, and maybe 408, 410 in 2025. And that's per the International Energy Agency. So with a relatively soft landing for the economy, that likely means that we're going to need investments to bring the amounts of oil and natural gas to market this year and next.
So if you go back globally, actually, so you look at Europe, some of the analysts are saying that the European economy is going to outperform the U.S. economy year over year in 24. In that scenario happens, will the U.S. continue to export liquid natural gas to Europe?
I believe so. The wild card really is the resolution of Russia-Ukraine. I mean, if that came to an armistice soon, you could see that some of the gas might flow starting later this year. But assuming the status quo, assuming that continues to drag on, and that there aren't short memories when it comes to where that natural gas is coming from for European markets. Right now, they haven't committed to a lot of long-term supply contracts for U.S. LNG, right? They've mainly been buying spot cargoes or inducing the Chinese to send their cargoes over to Europe. And as a result, for the last year or so, we've continued to see over 70% of U.S. LNG exports headed toward Europe. with a return toward normal seasonality this year, their ability to go from healthy storage levels entering this winter and replenish that is going to continue to rely on LNG cargoes. And right now, the source of growth for that, the source of cargoes that can be redirected, is mainly from the United States. So I see that holding.
Well, that's a positive. Then look at a lot of Americans. They love it. I'll use the term. They love to hop across the pond. They get on the plane to go to the UK or to go to Europe. They hop across the pond. Bloomberg's projecting that 2024 will set a record year for travel in terms of spending, in terms of miles flown. If Bloomberg's projection holds on that, on the increase in travel, what are we seeing from an increase in demand? Will we see an uptick in oil demand?
Well, likely. And the different forms of travel, whether we're talking about jet fuel, cruise ships, it's going to take energy for all of this, right? Usually petroleum based. And for overall oil demand, let's also keep in perspective the jet fuels like 7 to 8% of the global total of petroleum fuels, compared with diesel and motor gasoline, which each are around 30%. So those two have been mixed. Diesel's been strong and in relatively short supply globally, thanks also to Russia's war in Ukraine. Gasoline demand's been somewhat weaker, so we've seen weaker crack spreads related to gasoline, stronger ones related to diesel fuel. But what's interesting about jet fuel in particular is that it's historically been a strong coincident indicator of the economy. It represents the pace of air cargo as well as travel. And strong travel in turn reflects consumers have discretionary income, that they're spending, that they feel good about their prospects and being able to spend. And we're sufficiently past the pandemic now that what we're seeing isn't a reflection of pent-up demand to travel, but likely the underlying need to move people, to move goods. And by all indications, with global jet fuel demand around 8 million barrels per day, that's a pretty good sign.
That's a very positive sign. I'm going to give you some numbers here for our audience. The International Air Transport Association is projecting that 4.7 billion individuals will globally board planes in 2024, generating $964 billion in airline revenue. And you mentioned cruise ships, so let's give you some cruise ships numbers here. 35.7 million passengers expected to board cruise ships in 2024, up from 31.5 million passengers in 2023. There's clearly a lot of demand there for travel. A lot of this, in my opinion, from the research that I've done, is being driven by Generation Z, who likes to live the YOLO life. You only live once, as they prefer experiences over goods. If the experience over goods trends continues, and we're seeing that coming out of the pandemic, in my opinion, it's accelerating. If that continues to accelerate, to experience something, you have to get in a car. There's gasoline. You're going to get on a plane. That's jet fuel. You're going to get on a cruise ship. That's some form of diesel. You're going to use transportation to get to experience the diesel. Could that lead to a long-term increase potentially in oil demand just based on how this upcoming generation is viewing the world?
It's an excellent question. And with the eldest of Gen Z now in their mid-20s, we'd expect to see their influence grow in the next decade as they enter their prime earning years. At that point, they'll also have a greater influence on broad consumer markets and policies. Now, their preferences generationally are different, right? They may prefer experiences, but they also prefer urban living, custom products, things that are environmentally conscious and sustainable choices. And directionally, that spells less gasoline demand, but potentially more diesel fuel and all of the intermediate products that feed into the petrochemical sector, which in turn make about 96% of the products that we consume every day. So the pace of technology, the economic trends, urbanization, the affordability of housing in urban areas, mobility, these are all wild cards here. And to be clear, Gen Z, they are consumers. And as the population grows, it's likely the energy demand will too.
Then there's this little thing called Jay Powell and the Federal Reserve. We got the federal funds rate of 5.53%. At some point, that's going to impact the experience demand, but yet it's not happening. When those consumers start to feel the impact of the federal funds rate, which if they don't cut into in early first half 2024, we're going to run into a wall somewhere, and I'm going to use the economist term, something is going to break. If something does break and these individuals stop going on their experiences stuff, do we see a slowdown in oil demand, or does the growth of diesel, as we're seeing in the trucking, continue to offset that slowdown we could potentially see from the Fed fund rate increasing with Generation Z?
Well, I think directionally in the way you've laid it out, weakness for gasoline, strength for diesel. Diesel reflects both transportation of goods, industrial uses. It's a pretty broad economic indicator, coincident also, much like jet fuel that we were discussing. So I think directionally that's right in terms of fuel demand and a shift within the barrel itself. Now, Gen Z and its impact on it and how that will play out relative to interest rates, it's interesting. We can break interest rates and their impact into a few buckets. One is on housing through mortgage rates, another is through automotive and automotive loans that are taken out. And the third is credit cards, right? And if we look at the New York Federal Reserve Bank's overall outlook right now and their tracking of consumer credit, what we see is that record amounts of household debt have been taken on. Delinquencies have risen, but they haven't risen to recessionary or historically high levels. And it's interesting that even though the delinquencies, for example, on auto loans are up, the actual repossessions of cars, actually defaulting on a mortgage, that's been historically low. So we've seen people stressed, but they're dealing with it. And there will be limits to that, very likely. And I think one of the biggest uncertainties coming into this year, from a household perspective and a corporate perspective, is the delayed impact of the pent-up effect of having raised interest rates so much so fast. On the corporate side, by the way, where so many corporations, especially in the oil patch, are not considered so-called investment grade, right? You've got two factors here. One is that the rates rise exponentially as your credit quality goes lower. So it's one rate if you have investment grade credit. It's another yield on your bonds entirely, to the extent of 14%, 13 to 14% recently if you're not investment grade. The average across triple C and lower has been hovering between 13 and 14% in recent weeks. On top of that, if we look to now the Bank for International Settlements and their assessments, we see that there's upwards of $5 trillion worth of debt that has to be refinanced this year. So this is a big transition, right? Because for many years in a low interest rate environment, you relied on short-term financing as a company. You had very little doubt that you could continue to just roll that credit and keep these low interest rates going. And there was really no incentive with longer term rates having been higher to lock in for longer at that point. But this changed so much so fast, many companies were caught flat-footed. And now with an inverted yield curve, so to speak, where the rates in the future are lower than the short-term rates, this presents a dilemma where a lot of companies have trouble looking at how they're going to refinance. So in the fourth quarter, we stepped up from about $1 trillion worth of global corporate refinancings to, by IMF and BIS estimates, over $5 trillion this year and expected to be similar to that over the next 2 years. That means that as corporations have to take on and refinance a lot of this debt, that's a potential economic uncertainty at the negative side, because it means that there's less capital available to invest, less discretionary income at the household level, if you're talking now the household impact of this. We'll see where that goes. But the other lever is that the Federal Reserve and how much in the way of rate cuts might be expected over the next year. That's one of the key uncertainties where the market's priced in some of this already. But how far and how fast, if inflation remains sticky, that's the key uncertainty.
We had a strong jobs report today, which if you look historically what the Fed is doing, they're going to hold for longer. I don't see the Fed raising right now, but I could see them holding for longer. Maybe you get one 25 basis point cut before the first half of the year. I don't know, but what I'm seeing in data is that you're seeing the market divide. You have the corporate market that's cutting back on spending every which way under the sun. They're laying hundreds of thousands of individuals off. They're cutting their travel budgets. Let's look at CES this year, the amount of companies, I can go down a list that have pulled back from that, just as an example, because right around the corner there. And then on the other hand, you have consumers that just continue to spend. At some point, this is going to come to a head where, okay, so you're employed, I'm just going to be very kind, you're employed by Acme Corporation, and you're still spending, and they say, we're going to have a reduction of force. That, well, you've been spending like there's no tomorrow, I'll use the Prince term, like it's 1999. At some point, that's going to come to a head. If and when that does come to a head, what's going to be the overall economic impact? Is this going to be just economic uncertainty, or where are we heading with this?
I think it's economic uncertainty, and I do think that there's the ability to recalibrate and readjust over time. So just imagine, let's say per the scenario laid out, that the Fed does start cutting later in the first quarter next year. I've seen some views where people have consecutive cuts factored in through the second quarter next year, multiple cuts to try to stimulate. And you could attribute that to projections of a slowing economy, a presidential election year, however you want to frame it, it does spell the potential to have households have some relief along the way. That yield curve inversion that we talked about could reverse itself in that kind of scenario. Expectations really matter here. So long as the Fed has credibility in what they're doing and is keeping inflation at reasonable levels, the strong jobs report doesn't necessarily per se mean that they'll stay on hold for longer. I'm of the view that because price inflation has been so sticky and the sources of it have been embedded in things like the energy transition that we're talking about, right, with batteries and minerals and metals and the ability, how much price deflation can China continue to export in this environment? All of these and labor constraints, these continue to be issues that have led to price inflation, though it's come down substantially from where it was. It's not back to 2% per year either. And this is where monetary policymakers are going to have to grapple with. Is it reasonable to expect 2 to 3%? And at what point are you just kind of content that you can let off on some of these interest rates, knowing that many countries around the world haven't been able to raise their rates as much as the U.S. has? That's another issue here. So the global system, if we can keep energy prices as we've seen historically here at relatively modest levels without any big surprises on the geopolitical side, this is a tightrope to navigate as we're going across, but it's looked like it can hold together. That soft landing scenario is played out in a stronger way than many people expected.
If energy prices stay at historical levels, you're going to see a trend, at least that I'm starting to see, of consumers are turning in their electric vehicles and they're going to either traditional internal combustion vehicles or they're going to hybrid vehicles. The hybrid vehicles are booming. In 2023, U.S. individuals purchased over 1 million hybrids, up 76% year over year. And we're way past the Leo Mobile days when Leonardo DiCaprio took the Prius to the Oscars, and that started that whole boom. And then you look at analysts and bank reports, Toyota's, they missed the EV boom. Well, Mr. Toyota, he's sitting there very happy along with Toyota shareholders. If there is this, let's make this a U.S. statement, if there is a U.S. movement back towards the internal combustion engines, oil prices or gas prices staying at historical levels, where do we go?
Well, we were talking about the weaker crack spreads for motor gasoline and the relatively low prices right now. That's continued to be supportive of demand for internal combustion-based vehicles. And with electric vehicles, consumer preferences have always been key. The travel range, the infrastructure, recharging. With that, they're partial substitutes for hybrid or internal combustion engine ICE vehicles at this time, and at least as insofar as being a family's main source of transportation. Reliability is another issue. We assume that the electric motor is simpler, can last longer. We've got anecdotal reports where maybe the technology isn't all that. A generation ago, we thought of the advice parents would give is don't buy that car because these were all ICEs at that point, but don't buy the new model. Wait a year or two until the bugs are proven out of it. And cars have gotten so reliable over the last decade or two that advice has kind of gone out. People don't wait to buy the latest and greatest thing. And we're seeing with some of the new manufacturers that are scaling up, that there are issues, there are supply issues, consistency with batteries. We'll see how that plays out. But on top of this, electric vehicles, they remain relatively expensive. You got a new sales price of over, on average per Cox Automotive, over $53,000 per vehicle. I understand there are tax credits there, but that versus the interest rates and affordability issues, the things at the household level we were just talking about, this has to fit together and jibe. And now let's talk about the supply side on top of this. If we're comparing hybrids versus EVs in the way you posed the question, we've got major automakers that have invested really heavily in EVs, all of them, with the exception of just a couple, have really kind of put their whole corporate viability on the future of EVs here. And states like California are attempting to phase out ICEs on top of this. So it's almost a build it and they will come mentality with a finite amount of manufacturing capacity for cars. That likely means that ICEs down the road, especially used ones, could be relatively in high demand here. And during and following the pandemic, we got a taste of what it was like to have a shortage of vehicles. We saw the prices for used and new cars rise. Used cars had never been at such a premium as we've seen. And that's the tension that's going to go right now. So we're going to have to see, I think the way this plays out is that the demand will continue to be strong for gasoline-based vehicles. hybridization, improving efficiency, especially when it's cost effective. 20 years ago, the premium for a hybrid was pretty substantial, but not so much now. In fact, for many models, you can buy the hybrid at almost equal price to well-equipped ICE model. EVs, it's still a pretty substantial premium, and that may come down over time, especially as battery costs continue to come down. But the functionality has to be comparable. People have to have infrastructure. They have to have confidence that they're going to be able to use that vehicle in a pretty fungible way versus the one they've got today.
Despite all the reports, if you go on the road and you actually talk to individuals, and Mr. Jim Farley, CEO of Ford, did it last summer, the charging infrastructure is broken. And that's why everybody went to the NAC standard, North American Charging Standard, which was developed by Tesla, because for one simple reason, one simple word, actually more than one word, it just works. You plug it in and it just works. And that's what Tesla built for the vertical integration which they received. If you look at the electric vehicle versus the hybrid vehicle, and we look at a potential rocky economic line, it could be viewed as a cost savings for the consumer, because you mentioned the average price of Cox Automotive, roughly $53,000 for an electric vehicle. Well, and then on top of that, you've got an increased insurance cost. You have increased repair costs. Last week, the CEO of Cloudflare posted on X that cost him $7,000 to replace his windshield in a Rivian. $7,000. And he went to Safelite. It's not a high-end deal. He went to Safelite. It should be a couple $100, $7,000. And he said publicly his insurance was 4 times more than his Porsche Taycan. So let's factor that in, all that. Going to a hybrid, you've got cost savings. Hybrids run on a combination of battery technology and internal combustion technology. In Texas, you're pumping out a lot of gas. What role will Texas play in supplying oil to the market, and how many barrels per day is Texas projected to supply to the market?
Well, in recent months, by our estimates, we've been around 5.7 million barrels per day, so just under 6. And that is continued growth. It's largely the Permian Basin that's the shouldering source or anchor of that growth. But it's not just that. The Eagle Ford area, the Anadarko Basin up toward Oklahoma, these are areas that have continued to grow as well. The geology is good. The infrastructure and business climate are good. So this has helped Texas gain some share. It's helped the business be viable. And we haven't seen the same extent of growth coming out of most other states. New Mexico, the Permian side of New Mexico, has done quite well as well. And for natural gas, Louisiana has done well. But we're seeing that it's really the Gulf Coast states that are rising as the energy center, really, of the United States and the world.
So you mentioned 5.7 million barrels per day for Texas. That's a record amount. I want to congratulate you and the fine men and women in Texas oil and gas for that. That's a record amount. It's the highest since 1981. Does this record output continue?
Well, I think that's compared to data since 1981, but that's the highest ever for Texas. Can it continue? Absolutely. It's, again, the place that's most viable for continuing to grow. The thing that's interesting about the Permian Basin is the term is layered plays, but the geology is sufficiently complicated that there are different layers of depth, different kinds of geologic formations, the ability to develop and redevelop. There's another wave. It's called well restimulation or refracking. Eventually, the mature wells that have gone through the shale revolution, the hydraulic fracturing design that existed 10 years ago is very different than what's used today. Laterals are much longer. There's the potential to go back and have another wave of the shale revolution based on that. Now, today, it's not very economic to do that. You're still putting in several $1 million potentially of cost to recomplete a well. And the yield that you get out of that isn't necessarily there. But if we continue to have learning by doing, and this has been the hallmark of the shale revolution, as those costs come down, you'd be looking at the ability to continue this for decades to come. We'll see.
When they look at, I'll call it Shale Revolution 2.0, is that going to come down to new technologies, infrastructure, build-outs, or is that just going to come down to the entrepreneur that really, truly believes and is willing to put his money where his mouth is and truly develop it?
Well, you raise an interesting question embedded in that, and that's the entrepreneurial aspect, because so much of the technology innovation and the nimbleness of this industry has arisen from independent companies in the past. And with environmental safety and health governance concerns, we're seeing more overhead that the industry's had to deal with, whether it's a methane fee, whether it's environmental regulation in various forms, and at a federal level, the potential for redundancy across many of these regulations. That adds cost at the end of the day, and bigger companies have the ability to deal with those overhead costs in different ways. So that is a tension that's inherent as we're looking at how energy policy plays out under the current administration, how in a relative sense that affects everybody in the United States that's developing oil and gas resources. Again, Texas is advantaged both because of the quality of the geologic resources as well as the business climate and infrastructure. So I think it gets there, and I think it has the continued Shale 2.0 potential to get there, especially if we can continue to redevelop wells that take advantage, for example, of existing infrastructure. Those are things that point toward the future and a bright growth.
Is it the business environment and the infrastructure that allowed in Q3 the Permian Basin to set new production records that surpassed 10 million barrels of oil equivalent for the first time?
So this is remarkable, right? 10 million barrels per day. And keep in mind that all of crude oil production, and that's just crude oil, not natural gas liquids in other forms, but crude oil productions recently hit records in the U.S., 13.2 and 13.3 million barrels per day on a weekly basis per the U.S. Energy Information Administration. And here we are on a combined oil and gas basis, 10 million barrels per day energy equivalent coming out of the Permian Basin. Now, 80% of that's sitting in Texas, about 20% of it's sitting in New Mexico. But that's tremendous. And it has the ability to continue to expand, again, because of the quality of the resources, as well as the ability to get pipelines without dealing with the morass of many of the Federal Energy Regulatory Commission interstate pipeline regulations. With Texas's nimble intrastate pipeline system, has a unique ability to attract capital and respond to upstream production. So that's why the Permian Basin has really stood out versus anywhere else in the country. If you're sitting in North Dakota, you need interstate pipelines to make something of that. If you're sitting for natural gas in the Appalachian region, Ohio, West Virginia, Pennsylvania, you need interstate pipelines to grow. But with intrastate pipelines, that's been really the key to getting things. And then the Gulf Coast access and being able to export so much, that's been just a resounding success for the state of Texas and the Permian Basin.
It's set up for success. I want to give some more numbers to the audience here. Permian Basin now accounts for 27% of the total U.S. and oil and natural gas production. 27%! Is that because of the interstate pipelines? And if so, where are those pipelines going? Are they going to Galveston? Are they going to Houston? Where are those pipelines going in the state of Texas?
Well, you do see with the refinery complex in the Houston area and the Corpus area, those are your two major Texas complexes. That's where you want the pipelines to go to take advantage of this. And you get a lot of value added in the refining and petrochemical sectors that go with that. So that's been a booming success for Texas, to say the least. The economy in Texas is diversified, but oil and gas have been just a pillar of continued growth and a competitive advantage that many other places don't have. So if you were making the point earlier that Europe could continue to recover this year, depending upon what happens. But think of the energy costs. Think of how disadvantaged you are if you're trying to use natural gas as a process fuel in industry and having to import that gas at 3 times the cost of here in Texas, right? So we're sitting here with sub $3 per million BTU natural gas, despite the fact that we've been looking at record global demand for that gas, record exports of that gas, and historically strong domestic consumption. So it really is a resoundingly strong story, and it's the comparative advantage that Texas and the Permian Basin really have. It's what we can continue to grow in the future.
You will continue to grow, and I want you to reflect on this statement and offer your thoughts. In 2023, Texas accounted for 54.7% of U.S. oil drilling, its highest level since 2019. That's 54.7% of U.S. oil drilling. What are your thoughts? That's really impressive.
Almost 55% and growing. And that's the key, right? I mean, this is the relative tension in the way it's played out under the current administration federally. If you're looking at companies not willing to invest or are moving out of offshore production because they don't have line of sight in terms of being able to lease future blocks and commit to building the infrastructure. If you're looking to access to resources, restricted leasing on federal lands, a lot of the issues that have come up nationwide. If you were looking at resources in Wyoming or even New Mexico, you really need access to federal lands to continue to grow. Texas is largely private lands, so that's been another distinguishing feature here. So with a really good royalty system, good infrastructure, good business climate, Texas has positioned well to continue to understand where that value comes from and support the growth for the future.
Is there a cap in terms of market share percentage that Texas could hit. And I'll give you an example. This goes back to former employers. I'm not going to ask you to comment on them, but years and years ago, let's go back 10, 15 years, 1 trillion for the stock market was the magic cap. The only company your former employer, Saudi Aramco, was able to get over that. Google never hit it at that time. Apple never hit it at that time. That was considered the magic cap for how large a company can grow. Now, fast forward to where we are today in 2024, Apple's blown through 3 trillion. Microsoft said it a few times. Google's in the $2 trillion range. Well, obviously the $1 trillion cap went bye-bye. Is there a market cap in Texas for a percentage of oil drilling that you could hit? Or is this going to be very similar with the explanation they gave for the stock market where you thought I could only go so far? Then, guess what? Texas oil and gas just blew through that magic market cap.
It's an interesting question because it's not completely analogous to market capitalizations. You're looking at the market share of production within an industry. There are, of course, going to be some natural guardrails to that. I mean, the U.S. will only be able to grow so much. And at the same time as Texas is growing, to say that it's almost 55% today, that growth came in a relative sense to somebody else maybe not growing, right? In the longer term sense, as we're trying to put it together and think about where that could go, the amount of oil that's expected from the United States in terms of growth, the majority expected in turn to come from Texas by official estimates, whether we're looking at the U.S. Energy Information Administration, the International Energy Agency, CAPSARC as a Riyadh-based think tank, OPEC's estimates. I mean, with the exception of OPEC, all of them actually expect the United States to be the single largest growth source over the next 5 years. So if the U.S. doesn't bring it, you have to question, was the investment made in advance to be able to bring the supply that's needed to meet these consecutive records in demand? That, by the way, we talked about demand growing to record levels globally over the next 2 years, but the projections by almost all official estimates, including the U.S. Energy Information Administration, are that these continue to be consecutive records for the next 5 years. That's remarkable, right? That this means with the economy on track, even with slow, steady growth, that you continue to see a voracious appetite for energy that's continuing. And where that supply comes from, I mentioned OPEC's a little different. Well, OPEC sees itself as the one stepping up by 2028 to supply the largest amount. And you would expect that Saudi Arabia would probably be, as the largest supplier in there, the largest contributor in that case. But the U.S. is the wild card there. And at the outset, mentioned Argentina, which has the potential of, it's not on most people's radar, but that's something that in a 5-year time frame could begin to change.
And then if there's a change in administration, there's a change in the Senate, you potentially, use the word potentially, could see a resurgence in the U.S. oil and gas industry. From an investment standpoint, if you have a stable political environment that champions it. And if that happens, that becomes very, very interesting what it's going to look like to the growth. And if it does happen, we'll have you back on if it does become reality to talk about it when we're talking about facts and not speculating. Dean, in your opinion, what are the key things to watch in the oil markets over the next quarter before we have you back on again?
Well, we need to really look at geopolitics and whether we have a contagion of tensions in the Middle East. I mean, that's going to affect global oil markets in a substantial way. On the economy side, and more fundamentally, China's recovery their emergence from the pandemic was really important this last year. And people have relatively low expectations for this year for China as a result of that. So the IMF, the International Monetary Fund's expectation of growth for China this year is only 4.2%. It's minuscule. So with a relatively low bar, if global demand and global demand for goods and exported goods, especially those made in Asia Pacific, continues, it's not hard to imagine that China could outperform those low expectations. So that would be very positive both for oil and natural gas demand. And then lastly, as we just mentioned, presidential election year and the wild card going into that. Hard to say exactly how that will play out. There's a debate whether the Fed will be more accommodative, trying to support a stable environment leading up to that election. Wall Street Journal had an article recently arguing that don't expect that. So it really is a battle of sentiment there. And regardless of the reality, and I always go back to data, I'm not informed by consultant views, and I try to read the tea leaves as objectively as I can. And I can say that the indicators that I monitor from the economic side, the energy side, they look stable, they look solid, and there's no question the demand numbers have been at these record levels. But to win a presidential election, it normally favors an incumbent. And that means that to overturn the incumbent, you have to convince people that their pocketbooks are being bled dry or that they should be unhappy with the economy. And that's the battle of actual data versus perception of data is one of those things that's going to play out really importantly this year.
We're going to learn a lot before we have you back on in April. We're going to get the spending reports. MasterCard, Visa, Amex are all going to report later in the month here in January. So we're going to get that data. We're going to get consumer spending data that we can look at. You published some of the most fascinating, interesting monthly reports. So we're going to have more data from Texoga, which is the Texas Oil and Gas Association. We're looking forward to that data. So we're going to have a lot more data to dive through in April. And until April, Dean, what would you like our listeners to take away with them today as we look to wrap up this insightful conversation?
Thanks so much. Thanks for having me again. The key thing for people to keep in mind is that the data say the economies remain solid and demand, both for oil and natural gas, has continued to be strong. Investments, infrastructure, trade relationships to bring and move those supplies as needed to meet record high and growing demand, those are the keys looking forward, and those are the things that we need to watch. For weekly updates, we call it the chart book. Please go to Texoga's website, reach out to me on LinkedIn, and I'm always glad to discuss these issues. So I really appreciate the forum, our conversations each quarter, Grayson. It's been great, so thank you.
I enjoy it. Personally, I learn a lot. And I started this because I'm fascinated with the oil markets. And I'll quote Rick Rubin, a great famous music producer. He does it what he wants, not what the audience wants. And I do this because I care about this and I learn a lot. And so the audience that listens to Dean every quarter, thank you for listening. Dean gives incredible research. He's very kind with his time here. And Dean is 100% right. Infrastructure and investment matters. The future is bright. The future is autonomous. The future is a growing U.S. oil and gas industry. Dean, thank you so much for coming on the Road to Autonomy today.
Thank you so much, Grace.
If you've enjoyed listening, please kindly rate, review, and subscribe on your favorite podcast platform. Want to get in touch? Follow us on Twitter, Instagram, and YouTube at Road to Autonomy, or email podcast@roadtoautonomy.com. The Road to Autonomy podcast is produced by the Road to Autonomy LLC. The views and opinions expressed on the Road to Autonomy podcast do not necessarily reflect those views of the Road to Autonomy, its subsidiaries, its shareholders, directors, investors, or partners. The content discussed on this podcast is for informational purposes only. It should not be taken as legal, investment, tax, or business advice. Nothing is a recommendation that you purchase, sell, or hold any security or other investment, or that you pursue any investment style or strategy. The content of this podcast is presented on an as-is basis with no warranties, express or implied, of any kind. Financial mentions about companies in the Road to Autonomy Index and discussions about the Road to Autonomy Indexes are for informational purposes only and should not be relied upon when making any investment decision. Furthermore, an inclusion of security within the Road to Autonomy Index is not a recommendation by the Road to Autonomy Indices, LLC, to buy, sell, or hold that such security, nor is it considered to be investment advice.